The Small Business Development Center welcomes you, and we thank Will Russell for being our presenter today. The Small Business Development Centers are located throughout South Carolina. We provide no-cost consultation to entrepreneurs who would like to start a business and to owners of existing businesses. We can consult on business plans, marketing plans, loan packages, and specialty subjects like government contracting, technology commercialization, and exporting. We also provide training opportunities like this webinar, and those are typically low cost or free. We also connect business owners with resources within the community. And so if you need assistance with your business, please reach out to your local SBDC. We've got 21 offices in South Carolina. At this time, I'm going to turn the presentation over to Will.
All right, Robert, thank you. Again, I appreciate the opportunity to be here. My name is Will Russell, and I'm with a local CPA firm in Charleston, Jarrard, Nowell and Russell. We're about a 16-year-old firm, and pretty stereotypical in what we do. Work a lot with small businesses. Charleston is a very diverse market and is made up of a ton of small businesses, and is for those of you that are from this area and certainly from the state, you know that while we do have some big employers in Charleston, and certainly more recently with the addition of Volvo and Boeing and Mercedes and some of those, you know, if you go back 20 years or so, I think at one point, the Medical University of South Carolina was the biggest employer here. So a lot has changed in our market, but we're still made up primarily of small businesses, and we enjoy working with them and enjoy working with the Small Business Development Center. So I appreciate the opportunity to be here, and hope everybody made it through the storm last night. I think it was maybe a good warning for hurricane season that is now upon us, and hopefully we'll go through this season unscathed and won't get anything any worse than the storm was last night. But nonetheless, a good opportunity for us all to prepare ourselves. We're here today, obviously, to talk about basic accounting practices, and I've been as a CPA firm for 16 years. Prior to that, I was in corporate accounting or private industry for the first half of my career locally here in Charleston. I grew up in Moncks Corner and currently live in Somerville, so I do consider myself a local, of which there are many of us left, it doesn't seem. But Charleston's a growing place and a booming economy. So I often make the comment that accounting isn't necessarily the hottest topic or the sexiest topic, but it is a necessary topic, particularly for anyone considering starting a business or buying a business. I had a prospective call this morning completely out of the blue from a gentleman who was looking to buy a business and recognized that he needed someone to perform due diligence services on that potential acquisition. That's not his strength. He knows how to run the business, but he's not an accountant. Also recognized that he would need, monthly bookkeeping and tax preparation services. And so we talked through that, and hopefully we'll have an opportunity to work with him. But if you're on this call, you're obviously working with the Small Business Development Center or planning to, which means you're more than likely in one of two categories. I would assume you're either a potential business owner or already a small business owner. So hopefully in either case, we'll find that the seminar today is worthwhile and helpful to you and gives you some resources and some things to think about as you pursue this path of being an entrepreneur. I would encourage you, if you don't already or haven't already experienced working with the Small Business Development Center, to do so. Robert mentioned some of the resources they have. That their offering is tremendous, and a lot of people going into business for themselves don't always have. They're good at what they do, and they understand and know the business that they're getting into, but don't always understand contracts, for example, or how to prepare a business plan for a bank, or what your legal needs might be when you set your entity up. So these folks at the Small Business Development Center, again, have tremendous resources and can help with those things. So I'd encourage you to utilize their offerings and their resources. They're a good guide for everyone, and we've had the pleasure of working with them over the recent few years, and have helped some folks that have come through the development center get their businesses up and running. So enough about that. Let's get into it. And as I said along the way, if anybody's got any questions, by all means, put them in the chat box. We'll talk about them, and hopefully it'll make the dialogue of what can be a boring subject a little more exciting. So I wanted to cover these things on the screen that you see today, and we'll talk about each one in more depth, and what exactly is cash accounting versus accrual accounting. And some of you may look at that and go, well, I'm not even sure what accrual means. And that's okay. We'll cover that and talk about it, and talk about what the differences are and why they're important. And then two other terms that are, if you're not familiar with yet, you'll become familiar with are accounts payable and accounts receivable, and what exactly do those mean. And I find in working with a lot of small business owners that they are very familiar with their profit and loss statement, right? We all understand income when it comes in, expenses when they go out, and to oversimplify it, the cash left in the bank is profit. But a lot of business owners forget to learn to understand what the balance sheet is and what the balance sheet means. And so we'll spend some time on that. And then we'll talk about the profit and loss statement that most folks are familiar with, and how it's related to the balance sheet, and how the two financial statements are intertwined, if you will. And then bookkeeping records. What do you need? What's important? What's necessary? Differentiate that from tax records because they are different. And while your tax return is a report of your business activity, the records and the record keeping can be very different. And then lastly, just sort of a overarching or overall comments about how to prepare for your year-end tax preparation, and if your business is one that requires an audit, how do you prepare for that? If you're expecting to get financing from a bank, what you might expect to need or have or prepare for a loan application. And then lastly, what do you need in the event of a disaster? Again, I mentioned the storm when we started last night, and we can all agree it wasn't much of a storm. But when a larger hurricane comes, or your business is hit by fire, I just read over the weekend that one of the axe throwing places in North Charleston burned. Don't know the cause of the fire, but the owner said that they plan to rebuild. But what is he going to need now as a result of that disaster? Accounting can be confusing. There's a lot to it. We won't figure it all out here today, but we'll talk about some things, give you some resources, some ideas. Hopefully they'll be helpful. And you can take from this what you need. You can then go to the Small Business Development Center or meet with your own accountant or bookkeeper and get some help on the things you need some help on to get your business going or to continue running your business. So with that, let's start with a simple example of cash versus accrual. And there's a very, very basic financial statement on the screen in front of you. And on the left-hand side is a cash basis glimpse of two financial statements. On the right-hand side is an accrual basis glimpse at those same two financial statements with a fact pattern down below on the impact of the transactions that have occurred and what they mean to the financial statement. Now, a cash basis statement, as we'll see, it basically means if you deposited the money in the bank, then it's a receipt or income. And if you spent money, then it's an expense, as opposed to an accrual basis financial statement that you recognize revenue when it's earned and you recognize expenses in the period that the expense is associated with whatever it is you spent the money on. For example, an expense that might be accrued would be your insurance policy. Some of you may buy insurance and pay for it a year in advance. On a cash basis financial statement, you would expense that whole 1 year premium all at one time. On an accrual basis statement, you would expense 1/12 if it were 1 month, 3/12 if it were 3 months, half of it if it were 6 months through the year, so on and so on. So as you can see, you would associate the expense with the period when that expense was incurred as opposed to when the check was written. And you can have different methods of accounting for your books separate from your tax return. So let's walk through this example, and we'll start with the left side, the cash basis. And so they had a contract with someone, and the service was going to be provided in, it was a 2-year subscription, and they weren't going to receive the money until January 2016. So on the cash basis income statement, they didn't have any money to put in the bank. Therefore, they did not have any income. But they did have $600 in expense. So if you look at their income statement or profit and loss statement, as people refer to it, you can see that they have a loss or negative income or an expense of $600. And so if you look down below on the balance sheet, and we're going to talk more about the balance sheet in a little bit, but the balance sheet is a listing of your assets and your liabilities. And so on the balance sheet below, we don't have any cash yet, and we don't have any accounts receivable, and we'll talk about those more in a little while. And so Jeff, there's essentially nothing to report on the balance sheet. As a result of not having any income or having negative income, they have no taxes due either. So at the end of the day, they have a net loss of $600, and that's all there is to report. Very simple. If you look to the right, on the accrual basis income statement, you see a few more numbers, and we actually have things to report on the balance sheet as well. And so we have the same scenario. They have this contract. It's a 2-year contract, and they're recognizing $1,200 in each year. However, in this case, because they have billed the client for the entire $2,400, for the first year of half of that, the $1,200, they have revenue of $1,200 because they've sent an invoice to a client that hadn't been paid yet. And so it's sitting at revenue as $1,200, it's also showing up on your balance sheet as a receivable, meaning someone owes you money. And so we recognize that revenue, even though we haven't received the cash yet. And that's the big difference between cash and accrual on the revenue side. They have the same expense of $600. That hasn't changed. And so when we subtract our expenses from our revenue, we have an income of $600. Now, for this example, we have a tax rate of 10%. And so in the previous example, we didn't have any taxes. In this example, we do. We have a 10% tax on our $600 of income. Therefore, we have taxes due of $60, and we have a net income after tax of $540. And then on the balance sheet below, we have the $1,200 that's owed to us from our customer, and we have to pay our taxes. So we have a $60 liability to presumably the IRS or some taxing authority. And therefore, we have equity, or the value of our business, of $1,140. And so this is the key difference between cash and accrual. Now, as you can see from this standpoint, in one example, you have a loss and you pay no tax. In the other example, we paid a 10% tax, or $60. And so we can quickly see the advantage of using one method for your bookkeeping purposes to manage your business, and another method for your tax reporting. So as you go forward in your business, make sure that you have someone who's well versed in accounting, whether that's a CPA or a bookkeeper or just an accountant, or perhaps yourself, but make sure you understand the difference of the two, so that you may take advantage of any opportunities there would be. Now, if your business is of a certain size, it's pretty large. I think it's 250 million in revenue. You don't have a choice. You have to report on accrual basis for tax. But if you're running a $250 million business, you'll probably have an accountant that knows all those rules. So we won't go into those details today. So now we're in year 2. And if we go to the left side, the cash basis income statement or profit and loss statement, you'll see revenue of $2,400. And on the prior page, we had no revenue. So now we're recognizing both years of revenue, $1,200 in each year, all in one year. We have another expense of $600. We have last year's expense of $600 that we didn't get to do anything with, so it just sat there. So now we have income of $1,200, and we have the same 10% tax that you've seen before. And so we have a net income of $1,080. And then we have below on the balance sheet, last year we had no cash and no activity on our balance sheet. Now we have $1,680 left over in the cash that came in minus the expenses. Conversely, on the other side, we're only recognizing half of the income this year because we've already recognized half of it in the prior year. We also have our same expense again of $600. We have our same tax due this year again of 10% or $60. So we have another income of $540, which strangely enough matches our prior year of $540. And we have the same cash account balance of $1,680 down on our balance sheet. And so when you look at this at the end of the day, haven't we made the same amount of money, paid the same amount of tax, and wound up in the same financial position? We were just able to benefit one year from a tax standpoint, but at the end of the second year, everything is equal. Now, this is an oversimplified example, meant to be, so that we can understand the difference of the two methods of accounting. But in reality, in your business, if you're constantly billing customers and you're constantly paying customers and you're receiving invoices and you're sending invoices, it's not going to be an equal amount each year. And so as you approach year end, there's planning opportunities as you work with your accountant as to when you bill things, when you pay things, when you post invoices that you receive. That can have a significant impact on the financial result of your company and the tax you may have to pay, or the loss you might create. And so what you'll find with accountants is one of the primary goals from a tax standpoint, not necessarily from a purely financial statement reporting, is that we want to always defer any taxes to a subsequent period in the event that we can. And so you'll hear a lot of us saying, defer, and it just push it down the road, push the obligation down the road further, and pay the tax later. And there are plenty of ways to do that. This isn't a tax seminar, but it does bring to the point the differences in the financial reporting types. So again, just key differences to summarize that topic. Cash basis, you record revenue when you receive it, when you put it in the bank. Expenses are recorded as expenses when they're paid. There is a concept in the world of accounting called generally accepted accounting principles. And that's an authoritative body that governs our profession, and they don't allow financial statements reported on a cash basis. And the logic for that should make sense after walking through the previous example. It's fairly easy to manipulate cash basis financial statements, and what they want, what the generally accepted accounting principles strive to achieve, is to have a method of accounting that correlates the financial activity to the financial statement, so that revenue is recognized in the period that it should be, and expenses are recognized in the same period. So you can see the differences of accrual on the right-hand side. So if your business is of some size that it requires what we call reviewed or audited financial statements, just know that you will have to be able to provide accrual-based financial statements to meet the qualifications of generally accepted accounting principles. So this is a picture of a balance sheet, and I know it's small, and I apologize for that. Hopefully everybody can see it. And I'm just going to walk through and hit some highlights, because this is a somewhat misunderstood and oftentimes ignored financial statement. This is from an actual client. Obviously, the name of the business has been removed, but the premise of a balance sheet is to report your assets and your liabilities. And there's a fundamental equation in accounting that your assets minus your liabilities equal your equity, or your ownership value of your business. So in this case, he's got a healthy business. He's got just over $210,000 in cash, and he's got accounts receivable of $135,000 as of the end of the year, December of 2020. And that's up from the prior year. Last year, or 19, his accounts receivable $97,000. So during the year, he billed his customers, and he received payments from his customers. But at the end of 2020, he had $38,000 more in accounts receivable than he did in the prior year. So to me, he's, assuming he's collecting everything he's billing, he grew by a significant amount. And then below that, you see fixed assets. Now, fixed assets are your, what I'll call hard or tangible assets, things you can touch and feel. Your trucks, your desks, your computers, your machinery, your equipment. And the only other thing that's missing on this balance sheet that a business might have in terms of assets that would be significant would be inventory. In this case, this business doesn't hold any inventory, but if it did, if you had either raw material or fixed goods that you were selling, you would have another line on here that would be listed as your inventory asset. So your assets are things you own. They're yours, either your cash, your fixed assets, your inventory, or your receivable. Now the receivable is yours. It's a liability that of a customer that owes you money, but at the end of the day, the money owed to you is still yours. And obviously it's your job to go collect it. And hopefully you don't have an issue with collections. What we find a lot of times is that small businesses don't generally fail because they don't have enough business. Oftentimes they fail because they have too much business and they're thinly capitalized, meaning they don't have enough money when they start to support the activity of the business. So if you look at this balance sheet, and if he didn't have all that cash sitting in the bank and he had $135,000 owed to him and he needed money and he didn't have access to some form of debt or line of credit or something, he would be on the street, trying to collect those receivables so he could pay his bills or pay payroll. So managing your collections and your inflow is extremely important. And then managing your inventory. There are a lot of businesses out there struggle because they've got so much money in inventory that I think they need to have everything on the shelf. And that's often very difficult to manage when you're in a retail environment. Because too much on the shelf, you've tied up all your cash in inventory dollars, and then you're short on cash. You can't pay your expenses. And of course, the flip side of that is if you don't have enough on the shelf, then you risk not being able to provide what your customers need. So recognizing it's a fine balance. Just be sure that you're managing your business and you're watching your financial statements, and paying attention to your balance sheet. And so that's what we call the top half of the balance sheet. The bottom half of the balance sheet is what you owe, and then your equity in your business. And in this case, this business compared to his assets does not have a lot of debt. It has about $37,000 in accounts payable, and that's up from last year. Last year was just over 17,000, so his accounts payable grew 20,000, while his accounts receivable grew 38,000. And we'll cover that again. Accounts receivable is money that is owed to you. It's you've presumably sold something and a customer bought something, and they owe you money for whatever it is they purchased from you, be it a service or a product. Conversely, accounts payable is money that you owe someone else. So he owes his vendors just over $37,000. But in his case, the good news is he has customers that owe him almost 100,000 more than he owes his vendors. And then he has a credit card with a little over $5,000 that he owes somebody. So his equity in his business, his ownership of the value of his business, theoretically book value, not necessarily the market value of what you might sell it for, is over $300,000. So he's got what I would consider a very healthy balance sheet. A lot of cash, very little debt, not a significant amount owed to him. Not a significant amount owed to others compared to his cash position. He could pay all his payables and still have plenty of cash, and a fair amount of receivables. And again, if this were a longer course or a different course, we could drive down into his accounts receivable and see how old those receivables are and see whether he's managing his receivables or not. And if they're all current, or if they're more than 90 days old, he has a potential problem with people not paying him timely, and what might you do about that, and how do you remedy that? And there's a lot of issues there. But the balance sheet, the important piece of it is it's a picture of the health of your business. It sort of tells us where you are with your assets versus your liabilities, and you always want that number to be. You obviously want your assets to be higher than your liabilities. Understanding that some debt can be good debt. Not all debt is good debt. Some can be good debt when you're starting, or you're financing some growth, and the growth is there. Those can be reasons why you might have more debt than you want. But nonetheless,
Will, could I stop for a moment and
Sure.
offer a question?
Yeah.
So Valerie Fitzgerald asked, once you start one system, and I'm assuming that means the accounting system, is it wise to change to the other?
Oh gosh, Valerie, it could be, depending on whether or not your system, and I assume again by the question you mean bookkeeping system, is good and clean. And what I mean by that is that you've reconciled your bank statement every month, you've reconciled your credit card statements, and it's clean. If it's clean, I don't see a reason to switch. If it's just a big old mess, and sometimes our clients come in with a set of books that's just a big old mess, and that's okay. We're happy to help them fix it. But we have had some cases where it honestly made sense just to start over, and that's not the end of the world. We can do that.
And Valerie said, yes, correct, switching from cash to accrual basis system.
Okay, so that's a little different question, and it's not hard to do, and I don't want to get too deep in the tax components of this presentation. But if you're going to switch for purposes of tax reporting, only for your income tax return, you have to request that from the IRS. If you're switching for your bookkeeping purposes, that is much simpler. You don't need anybody's permission to do that. I would encourage any of you to manage your business on accrual. And the reason I say that is because if you're only managing on cash, if all you do is look at the money you put in the bank and you're not paying attention to what you're owed from your customers, then I question whether you're really managing your receivables, your accounts receivable, that's due to you from your customers, because that's when you recognize your revenue. It's not when it's received, it's when it's billed. And you should have a business plan that you put together, and you should manage yourself and monitor that business plan and compare it to your actual results on a monthly basis. When your books are closed and your bank statements reconciled, we should pull out that profit and loss statement and compare it to our budgeted monthly or quarterly profit and loss statement, and ask ourselves questions if something is low or high, or expenses are overstated, or revenue is understated. What happened? Maybe we lost a customer, but we've already gained a new one, and they're going to be in place a month from now. We expected this loss for a 30 or 60-day period, or maybe we hired someone new, and they were an additional headcount, and we recognize that payroll is going to be higher than our budget because we didn't budget for a person. So there should always be an answer to a question as to what's going on with your financial statements. So the next is a profit and loss statement. And again, his is on an accrual basis. And we start with his services that he provides. He has a cost of goods sold. And so we subtract cost of goods sold from his revenue. And then he has a gross profit. And then we subtract from the gross profit all of his expenses. And there's the common things you would expect to see: advertising, automobiles, computer software, insurance, interest, medical insurance, office supplies, salary for the employees, travel and entertainment, utilities. And so his expenses total up to be, for the year 2020, $220,000, just over. And we subtract that from his gross profit. And he had a net income that year of $75,142. And so what happens with this $75,142, and the way that your profit and loss or income statement, those are synonymous terms, relate to your balance sheet, is I'm going to go back to the balance sheet now. And you'll see down here at the bottom where I'm circling $75,142. So the income from the income statement comes over at the end of the year or in the period, could be a month or a quarter, to the balance sheet. And it flows into the equity section because that's income you've earned on your profit and loss statement that now belongs to you. It's part of the worth of your business. So these financial statements are very much interrelated. And so it's important that we look at both when we're managing our business and doing our financial reporting. And again, any of you that are working with a bookkeeper, an accountant, a CPA firm, ask them for their time on some frequent basis. It could be quarterly or maybe semi-annually, but to sit down with you and walk through and explain these financial statements to you so you understand what's going on in your business. I want to switch to record keeping. And switch over to a website that the IRS has. And I am not here to promote the IRS. I think they're generally the least liked person in the room. Although we do have to work with them, and generally speaking, they're good people that work at the IRS. None of us want to pay more taxes than we should or than we have to. And we find ourselves oftentimes frustrated with them, but at the end of the day, they don't write the law. They have to enforce the law that Congress writes. But they do some good things, despite most of our disdain for them. And they have various subscriptions and emails that you can subscribe to. And I got this one the other day after the folks at the Small Business Development Center had invited me to do this presentation, and I thought it was a really good one. And you can go to their website and search for this, but it just talks about record keeping and how important it is. And we find a lot of clients that'll come to us at the end of the year and they'll give us their QuickBooks file. And well, first thing we do, we go in there and look, and the bank statement hadn't been reconciled for the whole year. And we ask, is this something you want us to do? Or do you want to do it? We're happy to do it as long as they're happy to pay us for our time. Or do you want to do it and save the time? And oftentimes they don't want to mess with it. And so they'll have us do it. But the point is that's a basic accounting function and a basic record keeping function that should be done every month. Your banker, if you have one, and if you talk to them, will tell you that oftentimes when there's fraud in your account, it can be caught when you're doing your monthly bank reconciliation. And oftentimes when there is a fight over who's responsible for the fraud, one of the things the bank wants to know is, are you doing timely recons? And if you're not, oftentimes, it's my understanding, they're not as inclined to be responsible for the fraud themselves. Rather, they put that burden on you because you didn't perform the basic functions that you should have been performing as a business owner. So record keeping is important, and a bank reconciliation is about as fundamental as it gets. All accounting softwares that I'm aware of have a module or a component that will help you do that. So make sure you're doing that. And again, this just walks through some records, sources of income. You'll need to keep those. 1099s are the most common source of income for businesses, other than bank deposits, obviously. Keeping track of your expenses, items that you can claim for a deduction. The fundamental IRS rule is you need a receipt for anything over $25. So keep that in mind. There's a lot of apps out there you can use to scan receipts in now and all kind of fancy things. But at the very least, keep them by month, staple them to a credit card statement. There's just so many ways to do good record keeping. And keep those records so that at the end of the year, someone can take those records and prepare your financial reporting package, not only for your income tax return, but for your financial statements. Keep them well organized. IRS recommends that you keep them 3 years. We have always recommended to our clients that you keep everything 7 years. 3 is as far as the IRS will go back unless they prove fraud. If they prove fraud, they'll go back forever. Like I said, we recommend you keep them 7. Some really important things they mentioned: tax-related records. Always keep your W-2s, interest and dividend statements from your banks, any sort of government payments like unemployment compensation, things like that. Any things that are more government-type records. Make sure you keep those in good order, along with your bank statements. Cancel checks if you get them. If you get IRS notices during the year, unless you're going to handle it yourself, let somebody know. Don't stick your head in the sand and expect the IRS to go away. I can assure you they won't. You'll just get more letters. And the more you get, the nastier they will become, until they reach the point where if they're threatening collection, eventually they'll threaten to lien you and lien your bank and lien your property. And then the next thing you know, you'll wake up one day and the money in your bank account will be gone. And I'm not exaggerating. I don't want to be a fear monger. But if you're getting notices, make sure you get somebody to help you with them. The IRS is not always fun to work with. So, property records, if you buy or sell major assets, trucks, vehicles, real estate, things like that, make sure you keep those. Those are what I would consider to be more permanent in nature. If you buy a building, put that closing statement somewhere. You need to keep that until you sell that building, not just 7 years. And then record of your health insurance coverage, either for your business or for yourself. Those are pretty important. So just some record keeping ideas. And again, at the bottom, you can see, you can subscribe to the IRS tax tips, and they send them out weekly. And some things are relevant and some aren't, but it's not a bad idea just to follow along with what they have to offer in terms of information. And with that, we've got a couple more slides. We'll wrap this up. I'm gonna finish on time. Last year was a heck of a year for everybody, no matter what your business was. I can guess that it was a struggle, and in most cases, I'm probably right. But we saw the need, it furthered the need for timely and accurate financial reporting. Everyone wanted, PPP loans, and you had to submit documents for those. And there were submissions to the SBA for both SBA loans and what they called idle loans. And again, you had to submit financial documents for that. A lot of people were going to their bank, asking for, postponements on payment terms, and asking for interest only and deferments on principal payments and things like that. And I venture to say, at that stage, their bankers were wanting some current financial information. So the need for timely, accurate financial statements is always going to be there. But we're going to see in cases, like last year. I mean, hopefully we don't have another pandemic, but there'll be something that goes on that's going to require of you reporting of the financial health and welfare of your business. And these financial statements we're talking about are how you do that. So keep those as current and clean as you can. And then, what do you do with your current bookkeeping? Are you managing your business out of a checkbook, literally just writing down deposits and writing checks and paying people with a credit card or debit card, or do you have an Excel spreadsheet? Have you started a business and you're still commingling it with your personal bank account and you hadn't even separated it yet? Or do you have, QuickBooks and you've got a pretty refined process on a bookkeeper or an accountant, and you're closing those books every month and doing a bank recon and doing all the things that you need to do. If you're not the latter, I would encourage you to get some help and make sure you're keeping your financial records current. Being ready for an audit of your financial statements. You'll know if you're going to need that because of the nature of the business you're in, or because your bank's required it. The audit you won't know you're going to need to be ready for is when you get a letter from the IRS and they want to come audit your books. I'll tell you that, having been through a number of audits with agents, when the books are clean and you can answer the questions, the questions aren't near as hard and they don't last near as long. When the books are a mess and they have to search and you don't have good answers, you can't explain what went on, they're going to continue to search because they're going to search until they get answers. And so I've encouraged you, just from a tax reporting standpoint, to keep a clean set of books and a accurate set of books that you can sit down with anyone at any given time and go over and answer questions intelligently about what happened. And then again, I keep referring to the storm because it happened last night and it's fresh in our minds, but what's your backup plan if you lose that computer, or you're running a business on just one laptop And if you are, have you backed it up recently? Is it, there's so many backup ways now. You don't have to send, we're used to it. And when I started in this crazy business world, we used to have to back everything up to a tape at night. And then we had to take the tapes off site and on and on and on and on. We don't have to do that anymore. Technology has made it so easy that you can essentially have a simultaneous backup to the cloud out there on some of these servers of your server or your PC. That's almost real time. And so if you're not doing that, then you're not preparing yourself and your business for the event of a disaster. Because what you don't want to have to do is get all the way to August and not have a set of books that's clean. You lose something in a hurricane, and then you got to start over and redo your books all the way to the end of last year when you might have filed a tax return, so you have a good starting point. It's just, you just don't want to have to go there. And then if any of you have debt in your business, I would encourage you to sit down with your banker once a year at least. Make sure you've got a relationship at the bank with someone. If you have debt, if you don't have debt, you don't need a bank. Don't worry about it. Good for you. You should be applauded. But if you do, meet with that banker once a year. Make sure you have a relationship. Make sure you know when you need something that you can go to them. And don't surprise your banker. If you see things going wrong, go sit down with the banker and talk to them. Tell them what's going wrong. Ask for their help. Ask for their guidance. Meet with the folks at the Small Business Development Center and ask for help on a path forward. Meet with your accountant, but don't surprise your banker. If you know things are going bad, sit down with them and talk to them on the front end rather than the back end. They don't like surprises, and they're always more willing to help work something out than they are when it comes time to have to go collect the bad loan. So I mentioned this earlier, budget. If you're not budgeting yourself, you ought to be budgeting yourself personally, but certainly for a business, it is just that. It's a business. Treat it as such. Prepare a budget. Try to live by it. It's not going to be perfect, but it's a guide. You ought to have expectations of where you think your business is going, and just put those down on paper or in Excel or in QuickBooks or wherever you choose to put it. But use that as a guide to help you manage your business as you go through the year. And so that's it from my standpoint. We've got some time. If there's any other questions, be happy to answer those. If not, I've got a few more things I can talk about, but that was all the slides I had. So.
If anyone has a question, please type it in the chat box.
I'll hit on some common things that we see in financial statements that
Okay.
that sometimes folks struggle with. Let's talk about loan payments on your vehicle. Maybe you have a vehicle in your business and you're paying the bank back and it's financed for 5 years, and you make a monthly payment, and that monthly payment consists of typically two things, unless you have a zero interest loan, which are fairly popular right now, and that may be the case. But typically you would be repaying both principal and interest. And so a lot of times we'll see our clients post the whole payment to the profit and loss statement, to the income statement, as a vehicle expense or something of that nature, when really it should have gone to the balance sheet, right? The principal piece should reduce your loan because that's a liability that you have to the bank. And so we often find that the clients don't understand how to split those two payments up. Split the payment up into two components, interest and principal. And I see two questions. First, from Valerie, could you quickly discuss accounting management of cost of goods sold versus inventory? Sure. When you buy inventory, we'll just keep it very, very simple. You credit cash because you spent money, and you debit inventory, and inventory goes on the books as an asset, and it has some value. And so when you sell that inventory, we reduce the inventory. That same inventory that we paid $1 for a widget, we put it on the books as inventory. And then when we sell that widget, we remove it from inventory, and it goes to cost of goods sold. It moves, again, this is an interrelated part of the balance sheet and the profit and loss statement. When you buy inventory, it's not an expense, it's an asset because it's your inventory and you own it. And when you sell inventory, it moves from the balance sheet. It's no longer an asset because you sold it to somebody else. And so it moves to cost of goods sold. So that $1 for that widget gets credited from the balance sheet, and we debit it over on the income statement as essentially an expense or a cost of goods sold item. And it reduces your profit. You subtract cost of goods sold from sales to get to a gross profit number, but it is essentially an expense on the profit and loss statement because we have now recognized the cost of the inventory item we've sold. So that's how those two items are related. And the second question from Mara was, can you suggest an income cap where you would need to hire a bookkeeper? I'm going to make, $20,000 before taxes, and I wonder if that's enough to warrant. Boy, Mara, that's a hard question. I don't know that there's a magic number. If you can do it, I would say keep doing it. I guess my advice, without giving you a hard dollar number, because that's just a hard, everybody's income is needs are different. But if you can do it and you're happy doing it and it's not a burden, keep doing it until you reach the point that you're more valuable doing something else than bookkeeping. And at that point, go find a bookkeeper that can help you. The one thing I haven't talked about here, when you're using a bookkeeper or an accounting firm, just be careful with the controls around your business. A bookkeeper shouldn't be the one, unless it's an internal person that's part of your company that's has responsibility for dispersing funds. Your outside bookkeeper shouldn't be the one spending your money. So they shouldn't have disbursement ability or responsibility. I would encourage you to keep a tight rein on and controls around your cash and use of a credit card or any other way to disperse money. That should be left up to you as the owner until you decide that you're going to give that responsibility to someone that you can trust. And I hate to use the word can trust, because we often have times where clients, find fraud in their bank account, and the first thing they always say was, he or she's been with me for 20 years and I thought I could trust them. So I'm always sorry when I hear that, but there are ways to put controls in place, even when you get bigger and bigger and you have to rely on other people to do other things, to discover and detect fraud, pretty quickly. So I would encourage you to meet with someone, seek advice, and make sure that when you get to the point where you have other people having access to your cash, that you put the appropriate controls in place to protect it.
Okay. Will, we thank you for joining us today and sharing your experience and your knowledge. Just a reminder, if you've put your name in the chat box, you'll be receiving a post-event survey. If you complete the survey and return it to us, you'll receive the set of slides from today's presentation, and you'll get the link to the recording of the event. So please be sure that we've got your name and that you're registered attendance. If you did not type your name in the chat box, please do it now.
Robert, There was
Yes.
another question that came in.
Oh,
So
I'm sorry.
That's okay. This is another one from Valerie, and she says, I am full of questions. LOL. Is it wise to use the same accountant for personal and business?
Valerie, I would recommend that you do exactly that, because once, assuming it's a smaller business, and small can be relative, small can be 5 or 10 million of revenue. It doesn't have to be tiny. But yes, because they're going to be interrelated. And what becomes very important when the business starts making a lot of money is tax planning and minimizing your tax exposure. And an accountant that sees both sides of the business can do just that. So yes, I would always recommend, barring some bizarre circumstance, maybe you have a partner in your business and he wants to use his or her accountant to do the business. One of you has to agree to that, or you both just use the same accountant. But if you can control it, yes, I would prefer that you have the same person doing both sides. This has been a real pleasure. I hope everybody enjoyed it. I enjoyed doing it. So thank y'all.
Thank you so very much, Will. And just to repeat what Robert shared, for those that have confirmed their attendance, in the chat box, Robert will be sending out a post-event survey this afternoon, and the individuals that respond to that will receive a copy of the slide deck, as well as a link to the recording of this, so you can share this with others or people that work with you or within your business. Also, that will probably be distributed. Today is Thursday. More than likely, we will distribute that on Monday or Tuesday of next week. So please be patient with us as we upload the recording to our YouTube channel. So thank you, everyone, and thank you for attending. Please go to our website to see if there are any other upcoming events that you would be interested in. And once again, thank you. Robert, did you have anything else to share?
I just wanted to say thank you.
Excellent. Well, thank you all for attending, and we hope to see you in another webinar soon. Thank you.